Right.
Hi, everybody. Um, I'm Maida Peleus, part of Show Me Real Money, and Amy Shrew is my partner and my sister.
Oh,
Um, yeah, we're really glad you're here today, and because we have a lot of respect for what you do. You work really hard to earn your commissions. And the goal of today's session is simple. Let's help you not only keep more of what you earn, but also learn how to grow it. That's one of the reasons we're inviting special people like Chris Snowden today to talk about different kinds of investments you can use to grow your income. Um, now, I know financial conversations can feel really overwhelming. They're full of confusing jargon. Oops, sorry. They're full of confusing jargon, but we've really tried to simplify it as much as we could and make it realtor friendly. Um, so we're not about giving you confusing jargon and compliment and complicated ideas today. We want to make it simple, clear, and completely doable. And you can start right away. You can start with small starts, smart steps to get going in your journey with your business to help it create more wealth for you. Well, here's our little pictures. And today we're going to be talking about creating a business life plan. Um, without with you running your business rather than your business running you. I want you to ask yourself and be really honest. Who's running who in your business? Is your business telling you to pick up the phone 24/7, or do you have things under control? Does your business take over your life instead of fueling the life that you want? You're not alone, and today we're going to flip that script. We start out by getting really clear about the big picture. And because you don't know what you're aiming for, it's way too easy to get caught up in just staying busy instead of building wealth. So, our goal is to help you keep more of what you make. And here's a simple checklist to help you. How much money do you need to live the life you want? Not just survive, but to thrive. How many homes do you need to sell to reach this number realistically? And how do I keep more of what I earn instead of falling into the trap of just spending money when I make more? The mindset shift from busy to intentional is where everything starts.
okay.
So we thought we'd get started with you
Yeah.
guys just introducing yourselves a little bit, your name, your office location, and what you hope to learn from the class today. So Judy, you want to start?
Sure. Sorry, I'm having a little breakfast.
It's okay.
My name is Judy Richardson. I think we're all from Red Oak, and I work out of the Montclair office where I am right now. And I really hope to be able to figure out organization for my taxes. I just feel like every year, especially last year, now that I have an income property, it's taking me like 2 weeks to get it done, and I should be doing it like over a period of time, and I just don't. And so I want to have some sort of systems to be able to do that more efficiently, so I don't have everything, scrambling to get everything done on February 15th or whatever it is. Yeah.
Not good. We
No,
understand. Can help you with that.
thank you.
Suzanne, how about you?
Sure. Hi, Suzanne Thompson, also from the Montclair office. Um, I've been a realtor for a couple of years now, and I'm just kind of getting used to, being my own business and effective because it's been a little bit of kind of make it up as I go along so far. So, or read an article and did a thing. So I want to have a little bit more of a clear plan.
It's a good place to start, Suzanne. Thank you for joining. Chris, we'll get to you later. Adam.
Hi, I'm Adam Newsom. I'm also at the Montclair, Oakland office. And I am hoping to get out of this class some better sense of like how to save, how much to save. I definitely going through the first couple pages of the workbook and more of like the person who will one worry about my finances, but also worry like save and not enjoy my life. So I want to kind of find that fine balance of being able to enjoy my life and do things like travel, but also feel financially secure and not have to worry about it.
Okay. Are there some people who are hidden on here? I can't.
I can help you, Maida. I can help you.
Okay.
Adam, you and I are on the same page. So one time we will talk about that probably next week because, dude, I get you. I have on my list, Gail. If you could just share real quick.
Sure. Gail Lillian. I've been a realtor for 3 years and really interested specifically on the fiscal side of this, like less on the business plan side and more on the fiscal side of uh, very realtor specific best practices around managing the hopefully abundance of money that comes in and how to be smart about um managing it, anything relating to taxes, any of that. So eager to soak up whatever you teach us.
Thanks, Gail.
Thank you.
Jennifer.
Hello, I'm Jen Salas. I work out of the El Cerrito office, and similar to what everyone else is saying, yeah, I've also been a realtor a little bit over 3 years, and I just want to be able to better manage the expenses of my business, better budget, to have a better idea of, what I should be spending on what. It definitely has to do with taxes, but just yeah, making sure that yeah, I need a better system to keep track of everything. So yeah, I'm eager to learn what you have to teach us.
You're in the right place, Jennifer. Thank you.
Thanks.
Rachel. I don't know where Rachel is.
You're
You're
muted.
muted.
You're muted.
You're rude.
Hi,
Rachel.
everyone.
Now you're not. Hi.
Just talking to myself over here. Hi, I'm Rachel. I work out of the Berkeley and El Cerrito offices both, and just echoing what all of my colleagues are saying. I would love to be more intentional, more in control, and not just kind of live in, but like really harnessing everything that I'm doing and saving and spending. And yeah, like Gail was mentioning, some really realtor specific tools would be great.
Okay.
And just excited to learn more.
We're
Thanks,
excited to
guys.
meet you.
I think we got everyone except you, Vanessa. If I missed anybody, please speak now. But I think I got everybody. So Vanessa, if you want to just say hi to the
Yeah.
team.
I'm just, you know who I am, all of you, and I work out of all and none of the offices. But I just wanted to just kind of give a little bit of background as to why I put this together and what I'm really excited about. I won't be on all the classes and doing the work with you. I'm just going to jump in every now and then. They gave me the link. I've known Amy for years through the industry, probably well over a decade. She's had a really big career over at Realogy Anywhere. And we've just known each other. I've always respected Amy. She's always done some really great work at the company she's worked with. I met Maida recently at another conference, and Maida and Amy are sisters, and Maida has been working in accounting for many years. And over the years, Amy and I talked about this a couple of years ago, but they were working on putting together a really great course specifically in mind for realtors. And this is something that I've always thought was just such a shortcoming, that we never had either the tools or the systems or the recommendations. And if we got someone, then they were gone in a couple of years. And I just always felt like a big gap of what of kind of almost my own personal responsibility towards helping all of our independent contractors grow wealth. Because sometimes a lot of money comes in and then it goes right back out. And all of what you mentioned, taxes and systems and investing and all those things, setting up the right corporations, all of that, just felt like we could never get our arms around it. So they put together this class, they walked me through it. I've been anticipating it for a little while now, and I'm just really excited to have both of these really great women train this crew. And then I hope from this crew, we'll get some great feedback and can do it again with a broader array. But I want to thank the ones that showed up and are investing in themselves because it's a really important first step. And it's going to be work and it's going to be uncomfortable, but I think you'll learn a lot. So I'm excited for everyone. Thanks.
We are too.
Thanks,
Thank you,
Vanessa.
Vanessa.
Okay, Maida, let's get cooking. I'm going to go through a couple things with everybody. So
Okay.
first of all, Maida kind of skipped over our intro slide. I just want to share, and thank you, Vanessa, for your kind words. This course is based on my experience. I have been in real estate my whole career, married my husband right out of college, never used my degree. He's a builder. He brought me into Connecticut. I'm a New Yorker. I'm the East Coast girl. Maida's in Santa Barbara. She's a California girl. But what
Been here too long to be an East Coast girl.
yeah. So East Coaster here. But I ended up we built over 12 subdivisions, over 500 houses. I've built everything. The house I'm in now, my husband built. Been in real estate and then ended up going into education in the 2000s because I hated all the CE classes I take because they stunk. So I started writing my own course where NAR asked me to rewrite ePro in 2009, and I did with two other business partners. They're now on their third generation of it, but that got me on the map. I didn't realize what a big deal it was to write a course for NAR. As a result, I ended up starting to work at Realogy, now Anywhere, and I was their training director for 9 years. So I got to work in a Fortune 500 environment, and it really did help me. But bottom line is, I've been an entrepreneur my whole life. And about 15 years ago, Maida called me and said, can you retire? And I'm like, yeah, I own 7 units, real estate, I'm good. And she did the big sister eye roll. And she said, no, you can't. So we created this course based on what she put me through. Now, you don't need 15 years, but we believe that you can really get yourself in place in a couple of years and then be focused. But today, everybody, I'm honored to tell you that I don't have to work anymore. I can retire. And that's based on what my sister told me what to do. So she helps me. What we're going to show you is how to save a ton of money on taxes, but also how to redo your portfolio so you have money coming in and you can prepare that date for when you want to retire. And you know what? A lot of people in my office, they want to retire in their early 50s. Like, I'm a boomer, so I love that idea. I didn't do that. So whether you're starting, you've been in real estate 3 years, or you've been in over 30 like me, this program works. So what we're doing for you, you have the on-demand course and you all signed up for it. Hopefully you're all able to get in there. What we're doing, though, is these 3 live sessions with you. And we have an amazing guest speaker. So I'm only going to talk for a little bit, and then Maida's going to turn it over to Chris. What he's going to talk to you about is why traditional vehicles are something real estate agents should look like at. A lot of us think it's just real estate because we've never had a 401k. Many of us never had a 401k because we didn't work in corporate. So we're going to talk about that. So we have 3 live lessons to keep you on track this Monday and the next 2. There was a handout that you can use to follow along in the class. And if you're interested, we do have a business plan. The business plan is different than other business plans because it's written with this in mind, that you can fill it out and go to a financial planner and they can plan your financial path with it. And that's what I did. So about 7 years ago, I went to a financial planner and I was humiliated because I didn't think I had enough. And today I can retire, but that plan did it. And Chris, who's a financial planner on the call with you guys in Santa Barbara, he agrees that those plans work and he'll share that with you. We also created a GPT of the course. If anyone uses ChatGPT, this is a closed architecture GPT. If you have ChatGPT, you can click on our link and I'll show you where to find it. And you can ask it questions if you don't want to just go through the class. So use that. We're also going to be doing a tax planning strategy and business plan that you guys are invited to. And we do monthly classes if you want to add it to your fee, because we're going to interview really cool people about every part of our business. So that's what you get. And when you're looking at on the screen is what the course looks like. So that's where you would get that. And Maida, if you can go to the next slide. Okay. So in the class, the first section is called Welcome to Fiscal Fitness. And in there, you'll see it talks to you how to use the class. If right above where that arrow is, there's something called Join Our Community. If you haven't, go in and join the community because it'll pop up on your phone. It's where you can ask questions of us. We monitor it all the time, so it's right within the course. Thanks, Maida. So definitely join our community, and you can reach out to us, you know, now, and you're a lifetime member now, so you'll get invited to cool stuff. You want to download the business plan for next week. That's going to be part of your homework. Of course, we have the handout, and then you can see the GPT is right below it. And then the last thing is we do have monthly live webinars if you want to join those. So, and then you just go through the course and click and get through it. So that's basically it. And Maida, if you can go to the next screen. Bottom line, this is what you're going to learn in the class. First of all, mindset, which is not really on here, but do you have an entrepreneur mindset? Don't miss that section. We actually interview an amazing woman who talks about right brain, left brain entrepreneur, because most of us in real estate, we're creatives. We are right brain. So to get that left brain to learn how to read a P&L, and someone mentioned it, to understand how this all works to get your taxes, it's a struggle. So we kept that in mind as we wrote this course. You're going to be able to understand what you need to do, but we're hoping that you will work with the business plan and be able to then figure out what kind of business structure you want to be. So we'll go over that, right? If you're a sole proprietor, LLC, S Corp, and then we really want you to think about getting a financial planner. Chris is someone you can talk to. He's on the call today, and others, but it's really important to find someone who can help you with this. Don't do this yourself. We will then show you how to set up a proper retirement. What kind of financial vehicles are good for entrepreneurs? It's different if you're getting a W-2 every year versus a 1099. So that's important. And if you can go back, Maida, to the last
I'm
slide.
sorry, I admitted someone and I.
No worries. And then we're going to talk about all of the non-traditional vehicles, the real estate types investments. And that's where I come in, because not only do I own multifamilies, I own an Airbnb, and I do a lot of passive investing, which is great because I'm getting tired of tenants, and it gives me 22% return on my money every year. So it's amazing. So we're going to talk about REITs, and we're going to talk all about the real estate investments you can do on top of the traditional vehicles that are important as well. And then we want to make sure you put your plan in place. So all along the way, we'll be talking to you about how this relates to you being a real estate professional. And then if you can go to the last one, hopefully this is making sense, everybody. I'm doing a lot of talking. So just to remind you, the on-demand course is one part. So that's when you go in and you just read or watch the videos. So for example, this a little bit farther down, but you just click through, read, or watch the videos. And we do have interviews in every section with subject matter experts. You'll see Chris in there. He does a great interview for us. And then, of course, the downloads, which I showed you before. And last is the community. Please join the community because that's where it's going to be important, where we're going to post stuff. So I think that's me, right, Maida? I think I did everything I need to do.
That's it. Yeah.
And then the last thing I do want to share, if you can go to the next slide, we are not giving you any legal, financial, or tax advice. We want you to find your own advisor. Of course, my attorney made me put this in, but I love him for that. And then the last thing I'm going to share before I hand it over to Maida, for the homework for today, you are supposed to go to section 1 and read the first 10 pages. So if you haven't done that, it would be really good if you could. And I just wanted to see, did anyone have any questions about anything I just shared? I want to make sure that you're comfortable going through the class. And then at the end, Maida's going to share what your homework is for next week. So questions, comments, concerns?
I have a question.
Please.
I was a little unsure I see here where it says homework section 1, that it very clearly is called section 1, but when I was in the platform, it's called chapter 1. And so I wasn't sure when I was reading through what to read.
Thank you so much. So it was actually, I guess I should change it to chapter. So you were supposed to go through the first section to learn about everything on the class. And then in the next section, section 2, you were supposed to read a couple things about the mindset. So that's a typo there on the screens. It should say section 2 or chapter 2, the first 10 pages.
So in the
apologize.
tabs that you just showed us, where it had maybe chapters 1 through 6 across the whole course, it was
Right.
chapters 1 and 2 for today, right?
Correct.
Okay, great.
Thank you.
Sure. Thank you.
Okay, you're welcome. So if you haven't done the homework, please do it. We wrote it so you can get through a section I do it in 15-minute modules. So if you just know, I have 15 minutes, do 15 minutes and leave, you're going to get something. It's written with instructional design, so you actually get something within 15 minutes. So hopefully you can get back and do it. Okay,
Right.
Maida. Yeah, we're good.
Okay, now one of my favorite parts of the program is I'm really happy to introduce to you Chris Snowden. Chris is a friend of mine for the last 15 years. He is an entrepreneur himself. He started a financial management firm in Santa Barbara, has a beautiful team of about, he can correct me, but about 13 to 15 people. He has people who, like himself, who are a founder, but he has some wonderful people also who work with him, who work with some smaller clients, and so that's a really special thing for us because we can. It's easy to see if they can help you. Chris, I'm going to turn it over to you. I want you to brag about who you are and what you've done, and I think I'll ask you some questions interspersed in your presentation. Okay?
Thanks, Maida. That's super nice. And for everyone on the call, feel free to jump in if I'm speaking in vernacular, or if I'm using terms that don't make sense. Please stop me. And I like being interrupted. And Maida and Amy, thanks for having me here today. So I'll start by talking a little bit about channel wealth, and then we'll go into some of the items that you guys brought up. But just as a point of reference, everything that you guys mentioned and what you're hoping to get out of this is just you're asking the right questions. It's spot on. So, wondering about balancing, how do I feel comfortable about spending and savings and things like that? It's leading exactly to the right place. So, that's great. I think you're going to get a lot out of these conversations. So, Channel Wealth. So our firm is in Santa Barbara. We do have 14 members on our team. We bought a company that had about a 30-year legacy and have grown a little bit since then over the last 5 years. I really wanted to update our slide to have $1 billion in assets under management, but we're maybe 30 million short of that. So maybe next time. Yeah, we focus on financial planning and doing investment management for clients. And so the sort of deep financial planning work that answers some of the questions you guys has can be part of a bigger strategy when it's architected well by somebody like, Maida and Amy or your CPA. Really, if we could keep going, that'd be great. We do have sort of a division of labor at our firm. So there are people that are really focused on the nuances of planning and tax. We don't provide tax advice, but we can sort of feed you the right questions to take to your CPA. And we take inputs from them. One thing that's I think important for you to consider when hiring any financial advisor is how they're compensated. And folks that work at a firm that's called RIA, so it stands for Registered Investment Advisor, that means they have to operate according to the fiduciary standard, which means your interests have to come first. It's crazy that the whole financial services industry doesn't adopt this, but because they're of the types of investments that are out there and created by some of the big shops, like I'm going to pick on companies, but it's fine. There's great people at all these firms, but like Goldman Sachs, UBS, Merrill Lynch, right? They create investment products and they sell them to clients, and the way they're compensated for that could be perceived as not aligned with their own clients' best interests. Independent financial advisors tend to fall under the RIA banner. And so I think that just means, like there's no compensation flowing to your advisor outside of what they have declared that is going to be paid. And that comes through, advisory fees, whether that's by the hour to do financial planning work or to manage investments. We can keep going. So to change gears a little bit and talk investments, Maida and I were talking last week, and she said, "Why don't you find out what residential real estate has done over the last 30 years?" And so, um, a little bit of data here from S&P shows us that, and it doesn't seem reasonable, but this is what it is, that residential real estate has returned about 5% per year since 1990. I think maybe that is 1994. Um, so if we were to compare that to stocks and bonds, which we'll do in a little bit, it's a really good rate of return. One of the things that real estate has that we can't touch on the stock and bond side of the world is there's a lot of tax benefits, right? There's tons of deductions you can take for owning real estate, whereas if you're owning stocks and bonds, you can't. But we'll talk about some of that in a little bit. If we can keep going, please. So, your sort of financial roadmap, the financial planning work that a financial advisor would do, or a good financial planner would do, is going to be to create a balance sheet and create an income statement. Once you have those two items, so that means you're looking at all your assets, you're looking at all your liabilities. That's what your balance sheet is. Um, you're looking at, and then your income statement is going to be what are you earning and what are you spending? Those are the two kind of axes that most financial planning happens under. And income can be 1099 income, it can be W-2 income. I know everyone on this call is probably 1099 centric. It can also be K-1 distributions if you own real estate in an entity, right? You could have partnership distributions, K-1 distributions. And so understanding how those types of incomes match up with expenses, where taxes are applied, can be super important. Then your cash flow statement, for me, is probably the lifeblood of a financial plan. And that's where you're looking at these things over time. And we're going to look at the teeter-totter slides are still in here, right, Maida? Okay, good. So we'll kind of look at that over time and do, a little bit of my second grade handwriting. We'll show you kind of what we're looking at there. But this is kind of the bedrock for a financial planner for what they're going to give to you. And it does address a lot of the questions that you guys, not necessarily like how do I organize myself for taxes, but it can kind of give you an idea for what the output of those taxes are going to be. And then it really can help you focus on gaining a sense of confidence around forced savings and what that looks like over time. All right, if we can keep going, that'd be great. Enter the second grade handwriting. So this is something that Amy and Maida and I have been working on for, I guess, probably 18 months now. And this is kind of just a very simplistic way. It's sort of my kids are a little bit older than teeter-totter age, but this is where where I started the idea from. Um, there's different stages. So, if we were to look at the 4 points on here, it's earnings is on one side, real estate is on another side, cash is one of the ends, and then qualified accounts. So these are things that we're going to talk about a little bit. But if you want to keep going, made it to the next slide, I think. Should I go through each of the conversations on that one slide?
Yes, if you don't mind.
Okay, got it. Okay, sorry. So it's the first stop, right, in being a really good salesperson is to generate earnings. That was how my income was entirely sales based for the first, I don't know, 5 or 7 years of being a financial advisor. It's how do we go out and find clients? How do we find transactions to do for you guys in a very similar way? So you want to create stability in your earnings. And kind of as soon as you do that, then you start to have secondary questions, which some of the ones that you guys asked are on that list, right? Like, what do I do with my earnings? How do I know I'm doing this efficiently from a tax perspective? I want to own real estate because I love investing in real estate. I think real estate's a wonderful investment. It generates great returns over time. It's a very safe thing to invest in. And I would say 100% of my clients, I don't know, very close to 100% of my clients own real estate in some way, shape, or form. And it can be a great way to leverage assets and wealth over decades. But the first stop is to sort of create and fill up your earnings bucket. And once you get stability there, the way that you can start to do things strategically is to allocate to cash, right? So you start to have money piling up in either your entity account or in a savings account, kind of depending on what you've talked about with your tax advisor. But as soon as you start to have cash stacking up in these accounts, then you're spending it strategically. And the idea behind that, I guess I should back up one step, is I think what Maida and Amy are saying, and what I would advise, is start to think about how you spend that cash as a strategic decision. And doing so deliberately really empowers you, right? So if I have my earnings start to stabilize, I've saved up enough money to provide 6 or 12 months of my living expenses. Now I'm in the zone where I'm saying, how do I mitigate taxes? How do I make the next investment that I want to make that's going to benefit me over, this period of time, whether it's short, intermediate, or long? So as that cash bucket starts to get full, usually people in the real estate world want to own real estate. So you can move dollars from your cash bucket down into the real estate bucket or end of the teeter totter there, right? But it takes a lot of money to buy a home. So we're saving up cash or a rental property or whatever it is. It takes a while to save that cash up. So as that bucket's growing, you can invest that in something that's short term, 1 to 3 months treasuries or something like that. We're probably not speculating in the stock market with those dollars, right? Um, and then as we have done that a few times, right, maybe we start to feel like we have a lot of real estate. Or this would be an opportunity, I would say, actually, to talk to some sort of advisor, whether you have a strategic CPA or your financial planner or financial advisor. How am I out of balance? How's this working? How's this going to work today? How's this going to work in 10 years? Because if we keep buying real estate and we keep leveraging that real estate, we have to make sure that at some point we can turn on the income for us, right? Because if we just keep growing the assets, at some point we need to harvest them. So usually what will happen in this situation is once you start to fill up the real estate bucket, you want to have some liquidity, right? And then there could be moments where you need to have, or you'd like to mitigate taxes a little bit. And that's where the qualified account comes in. So on the top right-hand side of this screen, that does say qualified account. But that can be one of a couple different types of things, right? An IRA account. Anybody in the world can open an IRA account and contribute a little bit of money to it. Whether it's whether it's going to help you on taxes or not, depends on a lot of things. And this is where a CPA needs to step in and say, yes, Chris, you're eligible to make this much of a contribution and it'll help you reduce your tax liability by whatever it is, Y amount of dollars. That number can be pretty big depending on how much you're earning, what type of earnings it is, and how big a contribution you're allowed to make. So just really high level, anybody that has 1099 income, and if you don't have employees, you could/should consider having a SEP IRA where you're allowed to put 25% of your earnings. They're not complex accounts to start. They're not regulated super heavily in terms of how much you're allowed to contribute. The formula is pretty simple. You don't have to make payments to other people. So you could put up to 25% of your earnings into a SEP IRA. Now, that's a great starting point. For me, that's kind of like on the top of the list of things to consider. If I'm earning a couple $500,000 or $100,000 this year, I can put tens of thousands of dollars into a SEP if I have the cash in that cash bucket. And sort of knowing that I'm going to be doing this over a number of years. There are also, let me back up one step. There are limits, right? You can't put $300,000 into a SEP IRA, and those limits change each year. But that is a great starting point. If you want to advance farther, yeah, Maida, please.
I just want to interrupt for a second. The cool things about SEPs is that you can set them up very late. Like you could set one up now for 2024. So if you're doing your taxes and you've earned more than you thought, and you want to start putting money away based on this course, you could set one up today and fund it before your tax return is due, which personal returns are due October 15th. So they're good, as Chris said, they're a great starting point, but that's not where we want you to end up.
Thanks, Maida. Yeah. So, if you do that for a couple of years, the thing that's amazing about this, and I've done this myself, is that once you start to do it and you're pretty busy, right? This is not something you're looking at every day. You're not focusing on this kind of on a day in, day out basis. A couple returns down the road, right? A couple checks into this account later, you're like, oh, look, there's some real money in there. And then the markets kind of grind away and will generate some returns. And it does make a big difference. And that's, this is what we can illustrate, or a good financial planner will illustrate for you guys. And the power of compounding, applies to all that. But those are kind of the 4 points of this teeter totter, right? Stabilize your earnings and kind of get those to where you want them to be. Build up your cash bucket. From a financial planner is going to tell you you want to have 6 to 12 months of your living expenses in there. Maybe it's 3 to 6 months. It depends on your risk tolerance and your kind of appetite for savings. But having some, number of months of living expenses in that cash bucket. Beyond that, you're going to pay taxes with some of those dollars. And then you have these strategic allocations that you can start considering to real estate investments, to qualified accounts. And that's where having a financial plan really does make a big difference. All right, can we go to the next slide now, Maida? So, how would you compare? I know you guys have a lot of comfort with real estate and how returns work in real estate, but I kind of wanted to compare, traditional stocks and bonds to real estate and to other types of things. So we're going to see a few things here. We're going to look at the markets in a historical context. So let's go to the next slide, please. So the longer your investment time horizon is, the longer you stay invested in the assets that you own. And that can be, and I'm talking about securitized investments, right? Stocks and bonds here. I'm not talking about real estate or REITs or, private markets. The better the chances of experiencing positive and good returns are. So this is kind of a fun slide. The odds of winning at various casino games: roulette 44.7%, blackjack's 48. So really, I mean, you can see it's tilted towards the house, right? We don't win in these types of things. If we bought US stocks, right? And we're going to use the Dow Jones here because it goes back a really long way. So if we go back 123 years or 124 years, right? If we owned the Dow Jones for 1 year, we'd have a positive rate of return 73% of the time. 3 years, it'd be 86% of the time. So if we go to 15 years, if we're going to be long-term investors, and I know I'm not going to need these dollars for 15 or 20 years, 99.9% of the time, they've had positive returns. So it's a different risk dynamic the longer we stretch that investment out. Do you want to keep going, Maida? And if you guys have any questions, please jump in. I hope this is interesting. I kind of love these slides. I think it's good for me to be reminded about them as well, especially while, the news headlines come in every 6 seconds right now, and they all seem to be fairly.
So we had a question, by the way, let me just share. With a SEP IRA, you can also save tax-wise, correct? That was the question.
Yeah, so Judy, thanks for the question, and thanks, Amy, for pointing that out. So when you make a contribution to a qualified account, I'm just going to use this as a blanket term. If, for example, if you earned $100,000 and you don't make any qualified plan contributions, you will owe taxes on $100,000 of earnings. If, for example, you have a SEP account and you're putting $20,000 into the SEP, the earnings that you are taxed on would be $80,000 in an example, right? So you earned 100, you took 20 and you put it into the SEP, and now you're going to pay taxes on 80. So if you pay a 50% tax rate, we all live in California, it's pretty onerous here. That means you might have $10,000. And I would think about it this way. The government is loaning you $10,000 to invest, right, out of the 20 for hopefully like 20 years or more. So you're going to get returns on the $10,000 for the next decade or two. And then you will pay taxes on those dollars when they come out of the qualified account. So if you put money into a SEP or a 401k or a profit sharing plan, you can get up with a profit sharing plan, you can put hundreds of thousands of dollars away.
And
Really,
Chris, I'm going to interrupt you for a second. Isn't there a rule of thumb that if you put money in for 10 years, it doubles into the equities?
yeah, I think the rule is seven. It's the 7 by 7 rule. So if you get a 7% rate of return, your money doubles every 7 years. So in that example, if you put 20 grand in and you get 7 year, 7% over 7 years. In 7 years, it's 40 grand. In 7 more years, it's 80 grand, right? And that started out as a $20,000 contribution, 10,000 of which was essentially being loaned to you by the government because you're not paying taxes on it at that time. So it kind of allows more assets to stay in your household. If we kind of switch gears and look at this from a financial planning perspective, your asset base is larger sooner, which allows it to compound more. And if you have a plan and you know you're doing forced savings, Adam, I'm kind of thinking about you with like, how do I know if I'm balancing all the right things, right? I want to earn, I want to live today, but I also want to know that I'm doing right by myself in the future. Having that sort of forced savings that chips some of the earnings into a qualified account year in, year out really does make a difference over time. And it kind of gives you the agency to say, oh, I've done my savings. I'm doing my job. I can go on vacation now, right? I'm empowered to use the rest of these funds. Um, yeah, there's a question about short-term and long-term capital gains. So that's on a non-qualified account. So there's a big distinction here, right? An IRA is a qualified account. A 401k is a qualified account. You don't pay taxes on capital gains that occur in those investment accounts. It's a black box. If $100,000 is in there and it turns into $200,000 in 1 year because of growth and you sell all those securities, you don't pay taxes in that year. It's when you take a distribution from that account when you're over age 59 and a half, or hopefully later in retirement, right? Maybe even 60s or 70s. When those dollars come out, they flow to you as earned income. And so that's a pretty big distinction. For where capital gains happen, it's just like when you're buying or selling a house. If you've owned the home for 3 years and you bought it for 1 million and you're selling it for 1.5 million, that's long-term capital gains on $500,000. And I'm simplifying this. I realize there can be a lot of other factors there. But with a stock, if you own a stock for less than 12 months, that's a short-term capital gain if there is a gain during that period of time. If I bought a dollar, or in that same example, $1 million worth of stock, and I sold it for $1.1 million in less than a year, I'd get the $1 million back as my basis, and then I'd have $100,000 in short-term capital gains. Short-term capital gains flow to us as earned income. Yeah, Maida, go ahead.
I'm sorry. I just wanted to kind of say something about this because I used to hear this question all the time in my practice. Why do I want to invest in the stock why do I want to put money away in a qualified plan? Because when I take it out, it's taxed as ordinary income. When I buy real estate, it's taxed at a lower rate of capital gains. So here's the deal. We don't really know what your tax rate's going to be when you take out your money out of your plan. Your tax rate could be much less than the capital gains rate if you have things structured where you have non-taxable income in terms of dividends and interest coming in. If you have enough tax shelter on your real estate income that's coming in, again, that reduces your taxable income. So you're looking at the difference between a possible 30% tax rate, federal and state capital gains, because California doesn't have a capital gains rate, versus maybe a 50% tax rate of ordinary income if you're in the highest brackets. So you're looking at that 20%. But that money grows tax-free for how many years that Chris is saying. And I think that outweighs the capital gains. So just my point of view.
Yeah, I've a client that's like an MIT PhD. It's brutal. He's so smart. And he was like, should I do this tax? Should I pay the taxes and get the money and do it into a Roth account or a non-qualified account or a qualified account? And the math it's pretty good. The other part on investing in a qualified account, right? An IRA or a 401k, because it's more dollars to start and those dollars compound for longer. It makes more sense to pay taxes later. I will add this and then I'll move on because we could get stuck in this subject for a long time. I've also had a couple little old ladies who are clients and they're in a care facility and all they have is several $100,000 in an IRA. They don't pay taxes on the distributions from the IRA because of the cost of care, and you get a benefit that offsets any tax liability you'd have. And so if things go well and you have a bunch of money flowing to you in retirement, that's good. That's not necessarily bad. Are you going to pay more taxes? Probably. You're going to pay some more money in taxes. But if things don't go well and you've put that money into a qualified account, there are tax benefits that might allow you to use every dollar in there instead of pay half of them away in taxes. And so there, it sort of depends on your outlook on this type of thing, and everyone has their own kind of barometer for comfort on paying taxes. But if you really need the money, having a big qualified account makes a big difference. All right, so we'll keep trudging through here, and please continue to interject or ask questions if you'd like.
So Chris, we're coming to our last 10 minutes. So
Okay. I should be able to get us out of here. Or do you guys, how much to
I
wrap
have
up?
a little bit more to talk about once you're done. So
Okay, so I'll go
give
through
us
this
5 minutes to wrap up. That'd be great.
Perfect. So, nobody has a crystal ball. The markets do what the markets do. They don't make a ton of sense. I'll use this morning as an example. OPEC said they're going to produce a bunch more oil. We have all these declining economic indicators. Oil's up 2%. We just don't know, right? It doesn't make any sense. The more people, say they know what's happening, usually the less right they are. So as investors, we kind of want to not be super cute about it. We want to stay invested. So missing the best days in the market it will reduce the returns by a pretty astonishing amount. So if you stayed fully invested over the last 25 years, this is the set of returns that you would have experienced right here. I'm sorry, 30 years. You would have had 110% rate of return, right? More than that, 11% rate of return annualized. So you would have put $100,000 in 1994, it'd be worth $2.72 million today. That's just buying the S&P, putting it under your pillow and not thinking about it. If you sold and missed the 10 best days in the stock market, 2.72 million turns into 1.04 million. So you can see, right, your rate of return drops kind of a lot. When do we usually sell? When the markets are down, right? Because it's scary. And the stock market's the only thing out there where people sell when it's on sale and buy when it's expensive. It feels good to buy when in an up market. It feels terrible to buy in a down market. It really does. People are uncomfortable with it. If you miss 20 days, you miss the 20 best days, your returns drop down. You would have made $600,000 instead of 2.72 million, right? So it's a big difference. And if you kind of look on the right-hand side of this slide, the worst days that the stock market's ever had in history. I mean, this is going back through that same period of time, but like COVID is something we all remember probably fairly searingly. Most of a lot of these best days in history occurred during COVID when the market's going through this incredibly disruptive phase and it's trying to understand what's happening. Oh, everything's down 10%. No, it's going to be okay. It's up 10%, right? It's vacillating wildly. So it just is sort of this slide says, hey, buy, think long term, know that the market's going to do what it's going to do, and try not to sell when things don't look great because that's usually a day to buy. All right, let's keep going. I don't want to run over. So, one thing that a financial advisor should do is kind of match your risk profile, match where you are in your financial plan, kind of in your career arc with your investments. Are you a couple weeks away from retirement? Are you a couple decades away from retirement? You're going to own different things. What role does this portfolio play in your financial plan? Those are all things that are going to make a big difference in whether you should own a lot of stocks, which are risky, right? Or a lot of bonds, which are much less risky and are kind of consistent in producing the returns. And then it's going to be getting you comfortable with the type of returns and volatility that you're expecting to see. If you
I think
go back one more, Maida, and then I can.
Yeah. So I got into my stuff.
That's okay.
Oh, there you go. Is
Could
that
you
it?
go? Oh yeah, this guy right here. So there's a lot of data on this page, but just, aggressive, thinking about like a 15-year plan, right? You could be down 12% or up 22 or 23% in any 6-month period of time if you own 85% in stocks and 15% in bonds. Your average rate of return is probably going to be around 10.5%. And then I'll just go down to the very, the balanced type of account, right? Where you're going to be about half in stocks, 40% in bonds, and you're going to own some cash and cash equivalents in there. And the volatility on this account is much less. You could be down 8% or up 16% in any 6 month period of time. Most of the time, that's what this is sort of saying. So your foul poles, if anybody here is a golfer or understands golf at all, I don't golf that much, but like the idea is on the left-hand side with the aggressive portfolio, you're kind of at the driving range with your driver and you're just seeing how far you can hit it, right? It could be a fairway over this way or that way, but it could be right down the middle, be really far. But as you get closer to retirement, you don't really want to have a bunch of mistakes. You have a more inelastic demand for those dollars, right? I want $10,000 a month coming into my household. So you want to have a much more stable portfolio. The foul poles on this field are much closer together. And that's kind of what that's saying. Our returns are going to be a little lower. We're going to be down in this 8% range, but kind of getting matched up with your risk profile, what the account is doing for you, and having that understanding of going into it. Like, I know that this could go down 10% in, a bad market. When it goes down 10%, the question is, should we buy a bunch of stocks here? Because this is sort of what we planned for instead of I want to sell everything. So I guess we ended up kind of in the weeds on this subject, but I'll hand it back to you, Maida, to wrap us up.
Okay, well, this is Chris's contact information. If anyone wants to take a picture of it, let you do that, or we can always get it to you if you need it. And then I'm going to talk to you about a few more things. Finding a financial planner like Chris, a person who resonates with you, is part of putting together your team. We also believe that you should have a good CPA or tax preparer. Sometimes they're not CPAs, a good bookkeeper. And someone was talking earlier about getting organized for tax season. A good bookkeeper and a good CPA usually work in tandem and make sure that you have the data you need, that they need, to them in a timely manner so you can get your taxes done efficiently, which translate into a lower fee, and on time. Also, as you grow your business, you might want to have a business attorney because you may have contracts or things like that you need to have them review, and an estate planning attorney, someone to help you plan your own retirement and make sure that the money goes, that things happen in your retirement as you retire, then after you die, the way you want it to be. And then also mentors. I'm sure you all meet people from time to time that you feel really help you with your business. A good mentor also could come out of a networking group or a specific business mastermind group that you may belong to. And then a really good lender in your industry is great because they can help you seal the deal sometimes on selling the properties you want to sell to your customers. We talked a little bit more about the fact that if you have a good financial planner, generally you can end up with like 15% more wealth than those who don't. That's a proven statistic. You need to look for someone with CFP credentials, Series 7 and 9 licenses, and someone who can run different wealth scenarios for you. You want someone who can stress test your plan so it's ready for any market. And I want to, if you run back to Chris's last slide, I'm just going to take some license here. And you see over here where it says riskalized GPA 4.3. So we talk about stress testing your financial plan with your financial planner. They're looking for a number here that's 4 I don't know, 4 to 4.9, 4.8, 4.5. That means that it's not too risky and it's a good balanced portfolio for you to go through. Okay. If you are unsure and you're not sure about the person, you like the person, but you're really not sure, you can always go to investor.gov and check them out. If you check Chris out, he would show up as perfect on that website. Not that I did it, Chris, but so let us help you plan your future. And we want to talk about what parts of your roadmap are already in place. You may have the business mindset. You may have a business plan and budget, but we'd urge you to look at ours because it's a little different. Then you need to set up your appropriate business entity structure. And for those of you who have been in business for 3 years, you are at the perfect time to start thinking about this or planning to do this now or in the near future. Setting up an appropriate retirement plan, as Chris discussed, and it can just start out with a traditional IRA where you can put up to $7,000 or $5,000 a year, and depending on your age. But just to get the habit of saving is really important. And then setting up your investment structure and your diversified investment portfolio. We're really here talking about the kinds of real estate you might want to invest in and designing a real estate portfolio that makes sense for you. Later on in the course, we talk about that a little bit with some of the input that Chris has given us over the last year and a half. Okay, we're almost there. Next steps, download the business plan and budget for our next session. Read section 3, and I'll get some clarity on that for you just to make sure that we're not confusing chapters and sections, but it's about how to set up an appropriate business entity. And then prepare any questions on setting up the retirement plan. Next week, we have another guest speaker who's going to talk specifically about those. I know there's a lot more to discuss, so you'll have a lot of information by the time you're done with the class. We want to thank you so much for attending the course. If you have any questions, take a picture of this slide. You have Amy's email address, my email address, and our respective phone numbers. We are both open to hearing from you at any time if you have any questions.